If you're staring at the red numbers in your account right now, shivering, or watching gold, Bitcoin, and US stocks were holding strong, all take a dive yesterday like they planned it, feeling like the sky is falling. Then today's video is not just a must-watch, it's a must-rewatch. Why? Because what is happening right now is absolutely not the simple market correction you think it is. This is a textbook-level perfect storm, targeting retail investors globally, and a long premeditated financial hunt. Gold, that hard currency hailed by countless people as a safe haven myth, plunged more than 4% intraday, smashing directly through the psychological barrier of $4,900. It didn't even hold $4,800, it's a waterfall. Silver is even more exaggerated, crashing over 20% at one point, setting the largest single-day drop in 46 years. Is this a precious metal? It's more volatile than a meme coin. Look at the US stock market next door. It only fell 1.59%, but tech giant Microsoft saw hundreds of billions in market cap evaporate. Bitcoin is even more tragic, dropping over 12% in 24 hours, breaking below $65,000. 430,000 people liquidated. $20 billion wiped out in smoke. You might say, isn't that weird? Isn't it a safe haven asset? If stocks fall and people panic, shouldn't money run into gold? Why is gold falling faster than anyone else this time, even dragging Bitcoin its digital gold little brother down with it? You're definitely asking, has safe haven status failed, or is the end of the world actually here? That's the right question. If you only watch the news, you'll see a bunch of explanations. US employment data is bad. Panic, the Fed is changing leadership. These are just fodder, the media feeds you. The media only tells you what happened, never why. And certainly dares not tell you what the invisible hand behind it is doing. Let us state a core conclusion first, to put your mind at ease. Gold's long-term bull logic hasn't changed at all. Today's crash isn't the end of the bull market, it's a violent washout by institutional funds before launching a general offensive. Sounds a bit counterintuitive, right? Don't rush, let me break it down for you. First, we need to understand that this situation where stocks, bonds, gold, and crypto all get killed has a specific term in finance, a liquidity crisis. Simply put, everyone is short on cash. Do you think people are selling gold because they don't believe in it anymore? Wrong. Imagine you are a Wall Street fund. You've made a killing these past few years, bought a lot of Nvidia and Microsoft, allocated quite a bit to gold for hedging, and even bought some Bitcoin as a lottery ticket. Suddenly, one day, the CME Chicago Mercantile Exchange tells you, bro, we're raising margin requirements for silver and gold. You need to top up your account. At the same time, your tech stocks crash due to bad AI news. Your account has a serious floating loss. The broker calls to demand margin. What do? You have no cash. To save your leveraged tech positions or meet the exchange's requirements, you must sell something to get cash. Sell what? The tech stocks that crashed the hardest. You can't bear to, and you don't dare to, because liquidity might have dried up. So, what in your hand has the best liquidity, and hasn't fallen much? Everyone wants it. That's right, gold. So you LLC, a very weird but logical phenomenon. At the very beginning of a crisis, the moment of peak panic, gold often falls alongside risk assets, because at this moment, gold isn't a safe haven, it's a liquidity ATM. This has happened countless times in history. When Lehman Brothers collapsed in 2008, gold first crashed 30% before starting that magnificent bull run. During the pandemic meltdown in March 2020, US stocks fell, and gold fell with them. Why? To cash out and save lives? So seeing gold fall like this today, you shouldn't panic, you should be excited. It means market leverage is being blown up. Those wavering, cash-poor speculators are being washed out. These bloody chips are exactly the steamed buns dipped in human blood that big money loves most. But that's just the surface reason. We have to dig deeper. There's a shocking conspiracy here. Did you notice the timing of this crash is too perfect? Just a few days ago, Trump did something big. He nominated Kevin Warsh as the next Fed chair. Who is this guy? Many might not know him. Let me tell you, he is a famous hawk. What's a hawk? The group that advocates raising rates and shrinking the balance sheet to tighten money supply. Warsh came out swinging, accelerate the balance sheet reduction, and keep rates high until 2027. This shattered the market's dream. Everyone was hoping for rate cuts and money printing in the first half of 2026 to keep the music playing. Warsh poured a bucket of cold water on that. No way. Not only no cuts, but we're tightening our belts. What does this mean? It means the pricing logic for global assets has changed. Before, everyone thought money wasn't worth much, so they bought gold, Bitcoin, tech stocks. Now the Fed tells you the dollar is getting expensive, so all assets priced in dollars have to be The dollar index smashed through 105. Gold, as the dollar's nemesis, naturally comes under pressure. This is a textbook reaction. But brothers, there's something fishy here. Think about what kind of person Trump is. He's a businessman. He cares most about the stock market and economic data. Why would he suddenly nominate someone to crash the market? Does he not want to win the midterms? Does he want to see the U.S. economy collapse? Of course not. This is precisely a bitter flesh strategy performed by Trump and Wall Street together. You might think I'm spouting conspiracy theories, but look back. Aren't the bubbles in U.S. stocks, real estate, and even currency too big right now? So big that even the Fed dares not touch them lightly. If the bubble keeps blowing, when it truly bursts, no one can save it. So what's the best way? Controlled demolition. Get a tough guy in, shout about tightening, manufacture some panic, squeeze out the high leverage froth, and press out the water in the stock market. During this process, gold and U.S. stocks will definitely fall, but this is what they want. Why? Because only when it falls can funds reshuffle, and big institutions can pick up cheap chips at the bottom. Look at Morgan Stanley, Goldman Sachs. What did they do before this crash? They were secretly buying ETFs while laying out short positions in the futures market. They knew Warsh was coming. They knew CME would raise margins. This isn't market speculation. It's a slaughter with marked cards. Speaking of CME raising margins, this was the final straw, the iron bar that broke the camel's back. On February 5th, CME suddenly announced raising silver margins by 13.6% and gold by 10%. Releasing this news now is like throwing dynamite into a burning house. You have to understand, the futures market is leveraged. You use $1 to play a $10 or $100 trade. Now the exchange says no. You need to put up $2. If you can't produce that extra dollar, the exchange will forcibly liquidate your position. They don't care if you want to, or what the price is. This triggered a terrifying death spiral. Price falls a bit, triggers some liquidations. Forced selling, price falls more. Triggers more liquidations. Why did silver instantly crash 20% last night? Because the buy orders vanished instantly. It was all forced sell orders. At that moment, even if gold and silver were literal mountains of treasure, no one dared to catch them, because whoever catches them dies. This is why I call it a liquidity crisis. In that instant, the price of gold didn't represent its value at all, only the level of panic. Okay, seeing this, you understand half of it. You know, oh, everyone is short on money, the Fed is scaring people, and institutions are looting the burning house. But the question is, many people ask me, in this case, is gold done for? If high rates last until 2027, and gold pays no interest, why hold it? Better to buy U.S. Treasuries and eat the interest, right? This brings us to the core, most counter-mainstream point of today, the part that puts your cognition a step ahead. Do not think high rates can kill gold. If you think that, you've fallen into the Fed's trap. Let's look at a set of data buried by today's crash, but it's the real ghost story. While gold was crashing, the U.S. released ADP non-farm payroll data. The result, a mess. In January, the private sector only added 22,000 jobs. But on the other side, what about inflation? Inflation is still there. This is the scariest nightmare. Stagflation. High inflation, plus low growth. This is the situation central banks fear most. In a stagflation environment, stocks die because profits slide. Bonds die because inflation eats yields. Cash depreciates because the money printer can't stop. Who survives? Only gold. You say Warsh wants to keep rates high until 2027. I dare say that's pure bluffing. Once unemployment skyrockets, once the U.S. economy shows signs of a hard landing, no matter who is Fed chair, they have to obediently cut rates and restart the money printer. So the hawkish talk now is just to create space for future cuts. The louder they shout now, the faster they'll pivot later. And gold trades not on current rates, but on future expectations. You have to know, institutions have noses sharper than dogs. Why are they smashing gold now? Is it to buy the U.S. stock market that's about to crash, or to buy insolvent U.S. debt? No, they are smashing the price to trick you out of your gold. Think about it. If they don't smash the price below $4,800, if they don't wash out the wavering retail investors, if they don't blow up the leveraged longs, how can institutions enter? Gold is too expensive for them right now. They need a lower price, a price that makes you despair, to build their positions. This is an open conspiracy. They used the information gap, CME rules, and retail panic to manufacture this gold pit that looks like a disaster. Let's talk about Bitcoin. Many call it digital gold. Its performance in this crash was disaster level, breaking 65,000 and looking lower. Many ask, old Luo, Bitcoin collapsed. Does that mean gold is hopeless too? Quite the opposite. Bitcoin's collapse proves gold's irreplaceability. This drop completely pulled the pants off Bitcoin. It is not a safe haven asset at all. It is a risk asset through and through, a toy for when liquidity is overflowing. When the tide goes out, when people really need to save their lives, Bitcoin's high volatility makes it the first object to be abandoned. But gold, although it fell these past few days, pull back the timeline. Gold is still the darling of central banks. You ask, if gold is so good, why don't central banks intervene? Who says they didn't? Just because you didn't see it doesn't mean it didn't happen. According to the World Gold Council, central bank buying in 2025 was already at historic highs. And in January 2026, last month global central bank net purchases grew 12% year-over-year. Who is buying most aggressively? Besides those Eastern powers we know, even countries in the Middle East and Europe are buying. What are they buying? They are buying a sense of security from de-dollarization. Warsh's strong dollar policy suppresses gold in the short term, but long term, it's overdrawing the dollar's credit. The higher the rates, the heavier the interest on U.S. debt. U.S. national debt has already broken $40 trillion. Just the interest is how much a year? If they keep high rates until 2027, the U.S. Treasury goes bankrupt first. So this high interest rate is unsustainable. This is a huge logical loophole, and the biggest confidence for gold bulls. Do you understand now? Peeling back the layers, you find today's crash is a grand washing of the deck. On the surface, it's three negatives resonating: liquidity tightening, AI panic, hawkish Fed. In reality, it's funds doing a massive high-to-low switch, pulling out of overvalued tech stocks, clearing out leveraged retail, then sitting in the pit with cash, waiting to catch your blood-stained gold chips. You might still be panicked. After all, no one likes seeing their account shrink. You think, I get the logic, but it's still falling. Will it go to 4,000, 3,000? I tell you, the market is irrational. Overshooting to the downside in the short term is common. But I also want to tell you, people who make big money in this market never rely on predicting tomorrow's rise or fall, but on grasping the turning points of major trends. Gold right now is like a ball held underwater. The tighter they press, the deeper they push, the greater the force when it bounces back out of the water. It's like going to the market. Usually, cabbage is $5 a pound. Today, a storm hits, no one comes. The vendor is desperate to go home and yells $2 a pound. Do you scream cabbage is doomed with everyone else, or do you hurry up and buy a stockpile? Gold right now is that cabbage being sold off in the storm. Its nutritional value inflation hedge, safe haven, monetary attribute hasn't changed a bit. What changed is just the weather, the liquidity environment, and the vendor's mood. And there's an interesting phenomenon. Did you notice? This US stock crash, especially tech, is related to AI. Anthropic launched that AI tool that can replace programmers, scaring the pants off SaaS software stocks, having them in a day. What does this mean? It means faith in tech is shaking. People used to think AI was omnipotent. Now they find AI might be a destroyer, destroying jobs, destroying business models. When the tech growth story can't continue, where does the money go? After going around in circles, they'll find only gold, this thing that for thousands of years produced no interest, no cash flow, and looks a bit dirt. Basic is the most reliable, because it doesn't rely on anyone's promise or any company's financial report. It is itself. This isn't over. There's an even deeper logic regarding this crash, concerning everyone's wallet and wealth distribution for the next decade. Why did I say triple resonance? Besides the Fed and liquidity, there's a factor everyone ignored but is crucial: the invisible game of geopolitics. Don't forget, the world is never peaceful. While financial markets are bloody, the smell of gunpowder on the other side of the earth hasn't dissipated at all. Will gold, as a wartime lifesaver, lose its halo just because of a Fed chair nomination? That's a huge joke. Let's look at something even more thrilling: the algorithm black box. Did you feel this crash was weird? Not just deep, but fast. Too fast. Last night, in just tens of minutes, gold dove from above $4,800 with almost no decent rebound, leaving a long vacuum gap on the minute chart. What does this mean? It means the one smashing the market wasn't a human, it was a machine. Wall Street isn't guys in red vests shouting in a pit anymore. It's cold high-frequency trading algorithms and quant funds. These robots have no fear, no greed, only code. This is a terrifying chain reaction mechanism. Big institutions know $4,800 is a psychological line for countless retail technical traders. Many set stop losses at $4,790, $4,780, so institutions use chips to bulldoze the price to $4,799. Boom, those of stop losses trigger automatically. These become market sell orders flooding in. Then quant momentum strategies detect a violent drop and immediately short with full power. More sell orders crush down like an avalanche. That's why you see a vacuum drop. Bulls were stunned, buying dried up, freefall. It's not that gold became worthless. Algorithms manufactured a liquidity massacre in that time window. You think the market failed? No, this is the efficiency institutions want. Because only when liquidity dries up, do prices deviate severely from value. Gold at $4,600 is no different from gold at $4,900 hours ago, except it's cheaper. Cheaper enough to make those big guys with cash drool. So when you tremble at the big red candle, realize the algorithm is haggling for you. Without these cold machines creating panic, how would you get such a tempting price in the middle of a bull market? Back to geopolitics. Everyone is distracted by the Fed AI, Bitcoin. They forgot the big background. The world hasn't become more peaceful. Even if Warsh is Fed chair, even if the dollar index skyrockets, can it solve the Middle East powder keg? The standoff in Eastern Europe, the tearing of global supply chains? No. In fact, the harder the dollar sucks blood, the sharper geopolitical conflicts become. Other countries, to survive and not be harvested by the dollar, can only huddle together or use extreme means to break the dollar blockade. Gold here isn't just an investment. It's a political chip, a strategic resource. Pricing power seems to be in NY and London, but the underlying supply-demand logic has shifted. Eastern powers, oil producers, emerging markets, they aren't hoarding gold to flip it. They hoard it, so when the dollar system fails in extreme scenarios, they have a card to buy oil and food. Do you think they'll sell their life insurance because the Fed changed a chair? Fantasy. So this crash is a windfall for strategic buyers. I bet in a few days, ULLC News, Central Bank X secretly added tons of gold during the February 6th crash. You might still worry, what if it drops for another year? This is about mindset control, the divide between leaks, suckers, and sickles pros. This triple resonance crash is a perfect psychological war. Institutions know if it just slowly bleeds, people won't run, they'll buy the dip. Only a flash crash, a suffocating rapid kill, destroys psychological defenses, making you hand over chips in extreme fear. Notice how people dared to buy at 4,900, added at 4,800, but at 4,600, they are scared to buy and want to cut losses. That's dopamine and cortisol at work. To win, you must be a pervert who goes against human nature. Why did you buy gold? To get rich? No, for that go buy options or altcoins. You bought gold to protect wealth against a fiat system destined to depreciate. As long as the Fed's printer isn't smashed, as long as the $40 trillion debt doesn't vanish, gold's long-term logic is solid as a rock. Even if Warsh keeps rates high till 2027, the U.S. government interest payments will exceed $2 trillion a year. That's military plus Social Security combined. Where does the money come from? Tax revolt, cut benefits, vote it out. Only way, print money, borrow new to pay old. That's a Ponzi scheme. Gold is the only mirror in this Ponzi scheme. Warsh is bluffing. The harder he acts now, the harder the crash later, and the higher gold bounces. Your loss now is just a number. If you don't sell, you haven't lost. If you get washed out now, you lose your wealth and your ticket on the Noah's Ark of this turbulent era. Of course, don't be a blind bull. If you are high leverage, this is a lesson. Reduce positions, save your principal. But ignore the media-mongering fear about $4,000. Watch the dollar indexes, it's stalling. Watch bond yields they breaking banks. Watch the real economy. I won't say gold will skyrocket immediately. It might grind, jump up and down, make you doubt life. That's the characteristic of a gold pit. Funds will wash the last non-believers out. When no one dares talk about gold, a cloud-piercing arrow will shoot up. Headlines will change to Gold King returns. Don't be the one slapping your thigh and regret then. 2026 is historic. We saw AI crack, Bitcoin faith collapse, Fed's last madness. In this global reshuffle, bubbles burst, only hard things remain. Gold is the hardest. It survived wars, plagues, depressions, regime changes. It never went to zero. It won't this time. Those laughing at you now, their cash will be diluted by inflation. Their tech stocks might zero out from new tech. But your gold remains that dazzling yellow. It guards not just purchasing power, but certainty in an uncertain future.